Okay, let's just jump right in. Welcome to the deep dive on the latest earnings call for CleanSpark.
Right.
This is a company that is really shedding its skin. I mean, for years, the story was strictly about Bitcoin mining, efficiency, scale, that sort of thing. Now, we are looking at a digital infrastructure company making an incredibly aggressive and, capital-intensive pivot into high-performance computing and, AI data centers.
That's it, exactly. And our mission today is really to cut through the noise of, the quarterly numbers and get to what's really going on underneath.
The actual strategy.
The actual strategy. We're talking about the full story behind their fiscal Q4 and, more importantly, their full year 2025 performance. It's all defined by these massive capital actions and a remarkably ambitious timeline to become a comprehensive compute platform.
And the market reaction was pure whiplash.
Oh, complete whiplash.
Yeah.
But that huge rally that followed tells you exactly where investors are placing their long-term bets. It's on the infrastructure, not just the coins anymore.
So let's start with that initial whiplash, because the quarterly numbers, you have to admit, were undeniably a little soft.
They weren't great, no.
The Q4 GAAP EPS came in at -1 cent. That missed the street consensus of +8 cents by a pretty decent margin.
9 cents, yeah.
And then quarterly revenue, $223.7 million, also missed what people were expecting by about $4 million. So if you were just watching the short-term tape, you saw disappointment.
But focusing on Q4 just misses the entire point of the call. It really does. This is where you have to immediately shift your focus to the annual results, which were, they were phenomenal.
Right.
Fiscal year 2025 just proved the success of their whole scaling strategy. I mean, revenue more than doubled year over year.
To what, over $750 million?
$766.3 million, a 102.2% increase.
Wow. And the net income swing is maybe the most impressive metric they delivered.
It absolutely redefined the whole narrative. They went from losing $135 million the year before to reporting a massive $364.5 million in GAAP net income.
That's a huge swing.
And that translates directly into a $1.25 basic GAAP EPS. That level of profitability in just 1 year, that gave them the foundation for everything that came next.
And the stock's reaction completely validates this point. I mean, we saw the initial dip after the Q4 miss, right? A few percent down after hours, which is pretty standard.
Sure.
But once the market really digested the full year numbers and, more importantly, the forward-looking AI stuff and the capital plan, the stock just surged.
14% the very next day on huge volume.
Right. It signals that the market is officially valuing this company on its multi-year infrastructure plan, not a $4 million miss on quarterly revenue.
And what's really important about the financials here is that they achieved this massive operating leverage after the Bitcoin halving hit in April.
Which cut their revenue in half overnight.
Exactly. It cut their block reward revenue in half.
Yeah.
The fact that they maintained profitability at all says everything about their efficiency advantage.
Yeah, I mean, maintaining profitability post-halving is what separates the best miners from everyone else. How did they actually manage to absorb that shockwave without their margins just collapsing?
It all comes down to cost structure and discipline. Management reported that their gross margin for the full year held steady at 55%.
55. That's only a 1% drop.
A negligible 1% year-over-year decrease. And they really pointed to this as proof of their operational rigor, especially given that revenue hit.
And you can see that rigor pretty clearly in the profitability spread.
Right? You can. Their marginal cost to mine one Bitcoin for the year was around $43,000.
Okay.
While the average realized revenue per Bitcoin they actually got was roughly $98,000. That's a margin that, a lot of their peers can only dream of right now.
Okay, that's true. But we need to pause here for a second and clarify the true profit picture for you. Because the reported numbers, while they are impressive, they're heavily influenced by some accounting rules for digital assets.
Yeah, that's a really important point.
Explain that, because the headline numbers were just staggering. FY adjusted EBITDA was reported at this enormous $823 million. It seems impossible, like a margin over 100%.
And that's the key. That massive figure includes non-cash fair value gains on their Bitcoin holdings. So when the price of Bitcoin goes up, GAAP accounting says they have to mark up the value of their treasury, and that just artificially inflates the EBITDA figure. It's not repeatable cash flow from operations.
Okay, so if we strip out those accounting games to understand the real fundamental cash flow, the stuff that's actually funding this AI pivot.
If you look only at the adjusted EBITDA from core operations, so you exclude those non-cash gains, the number is closer to $305 million.
Which is still a very healthy number.
Oh, it's a significant number. It translates to an underlying net margin of about 40% on their revenue. But it's the figure you need to focus on to gauge their actual operating strength and how much cash they have to build these new projects.
Got it.
They also hit an operational hash rate over 50 exahash per second, all in the US. And now they're focused on deploying 19,000 of those new S21 XP immersion miners.
The super efficient one.
The most efficient, 13.5 joules per terahash. That's going to cement their place as the efficiency standard in the US.
And that strong, repeatable cash flows would allow them to pull off the most headline-grabbing part of this call, the capital strategy. I mean, they needed a ton of cash for this AI pivot, but they took arguably the least dilutive path you could imagine.
It was a truly remarkable sequence of events. It just screams confidence from management about their future stock price. They did two huge capital actions at the same time.
So walk us through the mechanics of that, because it's really unconventional.
Okay, so first, they raised $1.15 billion with a zero-coupon convertible note.
Zero coupon.
Zero coupon. They pay no interest for the life of the debt, which is 6.25 years. And crucially, it has a 27.5% conversion premium.
So the stock has to go up almost 30% before those debt holders can even think about converting it into stock.
Exactly.
Now, a zero coupon note, that sounds amazing for a growth company. But let's be the skeptic here for a sec. Isn't this just debt that will eventually become dilution if they hit that premium?
It is.
They're just kicking the can down the road. If the AI pivot takes longer than 6 years, they have to pay back over $1 billion.
That's the risk, absolutely. But they paired it with the second action, which offsets that risk and sends this incredibly powerful message.
The buyback.
A $460 million share repurchase program, retiring over 10% of their outstanding shares.
So just to get this straight, they took on $1.15 billion in 0% future debt to buy back 10% of their stock today and fund their growth.
Yep, that is not just confidence. That's a management team betting the farm that the value they create with this AI pivot will vastly outweigh that eventual dilution risk from the note. That's exactly what they're saying. They're saying, our stock is cheap, and the ROI on this new AI infrastructure will be far greater than the cost of dilution at a much higher price. And the proceeds are used strategically. $200 million paid down old, more expensive debt, and the rest is going straight into buying land and power for the AI expansion.
And they have a second source of non-dilutive capital, too, that's also generating income.
Right. Their huge Bitcoin treasury.
Their digital asset management desk, the DAM desk.
That's right. The 13,000 plus Bitcoin treasury, which is valued at, what, $1.2 billion? It's not just sitting there anymore. They are actively using it as a productive asset. The DAM team is running yield strategies, using covered calls and cash-secured puts.
Okay, walk me through that math again. How does using options on their Bitcoin holdings actually improve the CAF price they get for each coin? I'm trying to get my head around this DAM strategy.
Okay, think of it this way. When they sell a covered call, they are getting paid a premium today to agree to sell Bitcoin at a higher price later.
Got it.
In Q4 alone, this generated $9.3 million in option premiums. The annualized yield on those calls was about 12% and 8% on the puts.
That is substantial cash flow.
It is. And this whole strategy resulted in an uplift of $4,184 per Bitcoin sold in Q4.
So their effective cash per Bitcoin went from the spot price of 98 grand
to nearly $116,000. They're treating their Bitcoin stack like a synthetic high-yield bond, basically, boosting their profit with these sophisticated capital market strategies.
Which brings us to where all this money is going. The pivot to AI and high-performance computing. The capital's secured, the operations are super efficient. Now, how are they actually executing the move from being a low-margin miner to a high-margin data center provider?
Management was crystal clear on this. Their core competency is not mining anymore. It's securing massive, low-cost power and developing industrial infrastructure at speed.
That's the core asset now.
That's the core asset for the AI pivot. Their contracted power capacity grew 43% year over year. It's now over 1.3 gigawatts. They're shifting from monetizing hash rate to monetizing power capacity.
Okay, let's make this tangible. Where are the flagship sites where this is all going to happen?
There are two critical sites. First, you have the existing 250 megawatt facility in Sandersville, Georgia. That site is immediately AI and HPC ready. It's the low-hanging fruit for their first tenant.
The quickest path to revenue.
Exactly. And second, and this is the future, the new 285 megawatt Texas AI factory. They call it the Celery site outside Houston. Yeah, this one is purpose-built as an AI factory, with the first 207 megawatts scheduled to be energized in the first half of 2027.
In the hyperscaler race, though, speed is everything. What are they saying that's going to accelerate their timeline against, the established players?
They pointed to two key differentiators. The first is their partnership, their memorandum of understanding, with a company called Submer.
Okay.
This is a partnership for modular, liquid-cooled, prefabricated data center solutions. So instead of building on-site, the mechanical, electrical, plumbing components, the MET, were all built in a factory.
Like Legos for data centers.
Basically. They expected to save 10 to 15% over traditional construction and vastly improve their speed to market.
Factory-built infrastructure makes a ton of sense. What's the second differentiator? You said it was more nuanced, about power rates.
It's called dual-pronged load balancing, and it's actually brilliant. Management is working with utilities, especially in places like the TVA, to blend their AI load with their Bitcoin mining load.
Oh, interesting.
But the key is that they keep a component of the load, the mining part, as interruptible.
Wait, if they're blending mining and AI, how do they maintain reliable uptime for the AI? AI needs rock-solid, non-interruptible power. Aren't those two things, fundamentally incompatible?
And that's the strategic brilliance of it. The AI load is non-interruptible, but because they can immediately power down the mining load during peak demand, they give flexibility back to the utility.
Ah.
This creates goodwill and, more importantly, helps them secure long-term favorable power rates for the entire facility, including the high-margin, non-interruptible AI compute part. They're leveraging mining's flexibility to basically subsidize the power costs for the AI business.
That is the key operational lever. But let's talk about the big headwind here. The contract risk is massive.
It is the single biggest point of execution risk, period.
Yeah.
As of today, this company has zero AI revenue booked. Zero. Management is super confident. They're saying it's not a matter of if, but when they get their first customer. And some third-party analysts are citing post-call chatter that places like a 60 to 70% probability on them landing a hyperscaler deal within 6 months.
But that's still just talk.
It's all just talk. These next few quarters will be the definitive test of whether their capital rigor really translates to execution in this hyper-competitive infrastructure race.
So what does this all mean for you, the investor, watching this whole thing unfold? We've analyzed a highly efficient miner sitting on $1.2 billion in a productive Bitcoin treasury.
Right.
They just raised over $1 billion in 0% debt to buy massive power capacity, and they're pivoting aggressively into this stable, high-margin AI data center business. But there's clear execution risk and that big convertible overhang.
The risk-reward profile is dramatically bifurcated. The market has priced in the fear of failure, the risk of AI contracts slipping, the convertible note looming, even as sell-side analysts are already putting price targets in the low to mid-20s based on them getting this right.
Okay, so this is not financial advice, but if we were analyzing the options market based on this divergence, what would be an outrageous but plausible trade idea to play this specific setup?
The trade idea is to monetize the market's current fear and take a cheap leveraged bet on them actually realizing that compute platform valuation.
Okay, I'm listening.
We would propose selling a long-dated, deep-in-the-money put option, say an $8 strike, 18 months out. You're collecting a big premium by selling the fear that the stock completely collapses back to single digits.
So you're betting that the floor the company has established is stable, and you're getting paid pretty well for that belief.
Precisely. Then you use those proceeds to purchase an out-of-the-money call option, maybe a $30 strike, 12 months out. This creates a synthetic position where you are basically funded to take a cheap swing at the massive upside if this AI catalyst map actually plays out.
So you get paid to bet against the worst case scenario.
Mm-hmm.
And that payment funds your high leverage bet on the best case scenario, the successful AI pivot. It's a fascinating way to play the narrative.
It is. It's a high-stakes binary proposition that really reflects the current reality. Either they secure those contracts and the valuation explodes, or they struggle, and that leverage becomes a real problem.
So to recap the massive takeaways from this deep dive, we have a company maintaining a 55% gross margin post-halving, hitting 50-plus exahash scale, and making an aggressive shift to monetize power through AI and HPC.
And that shift is funded by a huge zero-coupon convertible note, paired with a massive share buyback, and an actively managed stack of self-mined Bitcoin.
The company's motto is "Be the Standard." Given their willingness to combine a huge buyback with a huge 0% capital raise, the critical question for you, the listener, to really think about is whether their proven capital rigor and operational excellence in the complex world of Bitcoin mining will successfully translate to superior speed and execution in the hyper-competitive AI infrastructure race over the next couple of years.
Because that execution is now the only thing that matters.
An outstanding analysis of an incredibly complex call. Thank you for joining us for this deep dive. We will be tracking those AI constructs very closely.